Dzień dobry. Good morning, my name is Przemysław Kwiecień. You're watching XTB trading webinar. So today we are going to discuss market euphoria that takes place despite all of these risks that emerged over the past couple of weeks, where we had energy crisis, where we have Evergrande risk of failure, and it looks like there is still some possibility of it, where we had this Fed tapering story, and despite all of this, markets rebounded and Wall Street is at the all-time highs again. So this is the story that we will focus on today. However, let's start from the top things that you need to bear in mind on Monday morning. So first of all, we had an interesting speech from Powell last Friday. FOMC president suggested that this is not a time to increase interest rates. However, he also said that the tapering is pretty much a done deal on the next FOMC meeting, and was more concerned with the inflation than before. So this looks like he could be opening the door for interest rate hike earlier than he wanted to see before. So this is the first point that certainly makes things interesting, and we should watch for how markets pick it up next days and next weeks, when we get more data and when we get the FOMC meeting on the 3rd of November. Second thing is Turkish lira, which is the hottest currency, but not in a good sense, as the currency saw the fresh all-time lows, or if you look at the US dollar Turkish lira pair, so that means fresh all-time highs after the President Erdogan started another crisis, expelling another diplomats, including the US ambassador, on top of the central bank cutting interest rates more than expected last week. So as you can see here, things do not look well for the Turkish currency. So basically the crisis, which looked pretty bleak back in 2018, right now these levels, I think that many people in Turkey, they would love these levels to return. And let's remember that the central bank, they had to increase interest rates to as high as 24% in order to mitigate the situation. So right now it looks like it's really a place of no return for Turkish lira. Look how much it increased. It was like 3.2, 3.5 in the mid 2017, and since then it's just a massive depreciation. There were two periods of corrections in late 2018 after this radical rate increases, and then after this market rebounded after the COVID slump. But then again the trend is so strong, and with the latest developments where a central bank seems to be losing all the independence, and this diplomatic crisis also intensify, it doesn't bode well for the Turkish currency. So definitely not something that has huge ramifications for global markets, at least not right now, but certainly one of the things that we want to watch. I mentioned Evergrande. Yes, the shares increased today as the company said it would focus on the EV business. However, more importantly, it looks like the company will pay the interest on the US dollar bonds, and there was a risk that they wouldn't, which would cause official bankruptcy, and it could have some spillover effect. So markets is happy to avoid that. As you can see, we had quite a strong rebound of the Chinese Hang Seng index from these deep lows that we saw just around 2 weeks ago. So China, obviously, unlike US, China is still at low levels, and yeah, if situation improves, if situation calms, there is obviously lots of upside here compared to global indices, and it seems for now that the government managed to contain the situation. They will probably force the company to get much thinner, to really downsize, to get rid of a lot of assets that could have a lot of negative impact on the developers, on the residential estate market in China, that could slow the economy down. But at least this scenario of some unpredictable chain of events seems to be much less likely, and this is critical for the markets. Markets hate these situations where things spiral out of control, so it looks like it doesn't happen right now in China. This week we have very intensive market calendar. We don't have a single huge event like the FOMC decision or NFP report. However, we have a lot of macroeconomic reports, starting from the IFO index in Germany today through Conference Board Sentiment Index in US tomorrow, Bank of Canada decision on Wednesday, US third quarter GDP, probably the most important figure of the week, on Thursday, German inflation, Bank of Japan decisions also on Thursday, and on Friday US PCE inflation, among other releases. So quite intensive week from macroeconomic perspective, plus there's earnings season, which we'll go to towards the end of our webinar. So it's quite an intensive week, and many things could happen. So let's start why indices rebounded so strongly. So first of all, during our latest webinar 2 weeks ago, I was arguing that even with all these risks, medium and longer term risks still definitely there, we could see a rebound on US indices, because we had this pattern of a second lower bottom on the Nasdaq. And even though of course market is right, even then 2 weeks ago it was around here, so it was still way higher than before, and it was it cracked this wedge. However, this pattern was very strong before, and it actually repeated once again. So after the second low we had some hesitation, and then market really went for it. So this happened again. There was actually no single reason. There was no a breakthrough from the news perspective, or from the even more from fundamental perspective. There was a solid start of the earnings season, something we'll discuss in a minute. There was this decline in Evergrande risk near term, which we just discussed. However, the bigger picture didn't it wasn't like it improved dramatically. So so you need to be searching for reasons elsewhere. And yeah, let's take a look at these reasons. So first of all, we had a news from Goldman Sachs that we are going to see record buybacks this year. Buybacks is a situation where a company, instead of paying dividends, where there is higher tax, they want to spend cash on buying back their shares. Even at these record levels, they seem to be happy doing this. So obviously this creates additional demand and pulls prices higher. So this is the first reason. Second reason is that equity inflows remain huge. This is of course a consequence of US households getting a lot of transfers from the government. So they are happy, they see markets growing, so they kind of invest this in equities. And third, Goldman argues that because this is funny for me, because the next year looks much more difficult, things that we were saying all along with this inflation, stagflation risk, with decline in liquidity and all this stuff. And they say because the next year looks more of a challenge, then you need to play the bull market now, because the window might be closing somewhere towards the end of this year or beginning of next year. So they argue this is when we need to finish or at least extend this bull market right now. So the final factor, like I already mentioned, is liquidity. So because of this Fed policy and the US Treasury preparing for this debt ceiling thing, we had a lot of liquidity influx from the spring of this year to record levels, and we still have nearly $1.5 trillion US looking for somewhere to to go to every day. So of course, with this over liquidity, it's hard to have a bear market, because there is a natural tendency for the money to return to risky assets, because they need somewhere to be in and look for this extra yield. So for as long as it happens, for as long as we have this excess over liquidity, it will diminish. It should start diminishing now with the Fed buying less, with the Treasury in a need of borrowing more. So this will be declining, but it will be a process. It's not going to slump to zero next day or next week or next month. It's going to be a process. So right now there is still a lot of over liquidity, and of course this means that the markets are strong. And as you can see, S&P 500, they just ignored this message from Powell last week, where he said, tapering will be there, inflation is higher, and we may react at the end of the day with interest increases next year. So there was a very short-term impact, and again today we are on the rise. So it looks like markets are really with pink glasses, and for as long as this over liquidity is there, this bull market could continue. Maybe this window is no longer that wide open. Maybe this time frame is already closing down a little bit, but right now at least the momentum is there. Okay, let's now move to the earnings season. Like I said, a good start. As you can see, all of the stuff is nearly everything is in green, which means that you have growth versus last year, which is not surprising because this was pandemic impacted quarter. However, you also have most of the time you have better earnings than expected, which again is not a surprise, because consensus on Wall Street is always set low enough for companies to beat it. However, if you compare how much they beat it this quarter to previous quarters, it also looks fairly good. So on paper, this earnings season looks strong. There are risks pointed out by companies like Intel, Tesla, IBM, and Snap already, that this supply chain crisis is going to bite, but it's going to be next quarter. So markets, with this hype and with this euphoria right now, they do not seem to care too much. And this week we're going to have really important chain of reports, starting from Facebook today, through Microsoft, Google tomorrow, and Apple, Amazon on Thursday. These are the 5 key reports that we're going to see this week. So-called big tech. It's going to be interesting from Facebook and Google if we see this, prosecution mentioned, how this could possibly impact them. And in case of Apple, obviously, it would be the most important to see if they are worried about components. All right, so finally, the last section, a quick look on the inflation story from the 70s. Yes, it's 50 years ago, but it's the last situation when we had inflation soaring from a period of very low levels. As you can see, it was benign at first. We had a long period of low inflation in the 60s, and also strong bull market back then. And then when inflation started to accelerate at the beginning of the 70s, first it looked like it was a temporary stuff, a similar story that we hear from the Fed right now. But then obviously things deteriorated very, very quickly. So let's see how this impacted markets, and which asset classes provided some insurance against this inflation. So equities did relatively well at first. All these lines here is total returns deflated by CPI index. So at the end of the decade, you can see if asset class was in real terms above 1 or was not there. So indices, S&P 500, they initially fare relatively well. There was a short-term correction in 1970 in response to this first spike in inflation, but then as investors hoped the situation was temporary, the index actually rebounded quite strongly. But obviously when the situation eventually got worse, equities tumbled, and despite the recovery in the second half of the decade, they remained in the red for the rest of the decade. Interestingly, you had cash, which is bank deposits and bonds, providing insurance against inflation. But do not hope that this is going to be the case this time around, as back then you had very high interest rates even at the beginning of this period, something that's not gonna happen this time. And the assets that delivered the most protection were precious metals, especially gold, that provided returns close to 4x during the whole decade in real terms. So really impressive thing from gold. However, there are a few things that you need to bear in mind. So first of all, the Fed actually tried to protect the real value of the dollar at the beginning of this period. So even before this inflation spiked so hard, the Fed had policy rates above 9%. I can't imagine this rate right now, frankly speaking, and bond yields was above 8%. The thing is that the Fed could afford it. The US GDP, US debt was around 35% of GDP. Currently it's 125% of the GDP. So should the Fed increase interest rates to 9% or even above, as they did during the 70s, they could obviously very quickly impact fiscal policy, because they would need to pay so much for debt servicing. So even inflation is lower and bonds or deposits are almost guaranteed to lose value, because inflation is going to bite and interest rates are unlikely to be higher than inflation. So yes, we saw gold and silver doing very well, especially during the mid of this decade. However, bear in mind that the gold standard was abandoned by the US in 1971. So gold was seen like as a real alternative. Today, the gold is not shining so brightly. There is, many reasons. First of all, we still have a strong bull market on equities. Second, there is hype in cryptocurrencies. So some of the shine is being taken away. However, it doesn't mean that gold might not be a good inflation protection. Actually, in the longer term, it could. In the short term, bear in mind that the Fed may still deliver one final kind of inflation scare. As you can see, US bonds are declining, which means that the yields are rising, and if the Fed actually sharpens their tone in the next few months, like suggesting, okay, look, we underestimated inflation, we need to react. So the first reaction from the gold market would very likely be negative. So we could see this, as you can see, this period of lackluster price dynamics. It could be extended if the Fed, or we could even see lower levels if the Fed admits, look, we need to act, even if it doesn't mean 5% rates. Of course, they're not going to do this, but if they suggest we need to start increasing interest rates. However, in the longer run, I think if you can withstand this, if you can or if you can enter the market in that point, the Fed is very unlikely to be tightening for a long period of time, because they will hit the economy that nonetheless is going to suffer from this supply chain thing. So over a longer run, it might be the case that even despite the fact it's not going to be another story like in the 70s with the gold standard, still precious metals could do relatively well. And with equities, they were initially less overvalued, looking at historical indicators that price to earnings, price to GDP, and still underperformed. So you need to answer yourself, even like we are saying with the indices. Look, we are in a strong bull market. We have this over liquidity. There are reasons for in the short term for this market to continue this bull market. Then obviously from a longer term perspective, this is a real risk, because we have record overvaluation, and if there is tightening, if there is prolonged inflation, this is a real risk for equities. Okay, ladies and gentlemen, thank you for your attention for today. Have a good week. Track our news section in Xstation Mobile, and we'll see each other next Monday.